Well, welcome back to another week's edition. Speaking to John Forrest Little from the Pickaxe. Man, I love these. I can't wait to speak to you when we do these, because you bring out some great charts.
Yeah.
And you brought a couple of good ones with you again this week. How have you been, by the way?
Doing well here in dystopian United States. Always, when we turn on the TV, I'll say, "Guess what, honey? Let's watch how many mass shootings there were," and it's usually 2 a day. So
Yeah.
that's
Well,
that's
it's pretty dystopian here in Canada as well. You've got people actually voting for mayors that will tax you. So that's, we've hit the twilight zone. But you know what? People are waking up. They are seeing what's happening. They may not yet be quite at the point where they're saying, how do I make these changes? But something we've often talked to people about is you definitely see it in the States, things changing. You don't like the agenda on this brand, whether it's what you're seeing coming out of a network or what this company is selling you for beer. If you don't like what you're seeing, you don't have to buy it. You can unsubscribe, and the power of the people is being shown. And I think some of the charts that we're looking at today are going to show that as well for what's coming. Let's start with this first one. You brought with you. Can I make this bigger? No. Sorry, guys.
There you go. That looks good.
So,
and look at that massive run up from 1970 to in 10 years. It's basically, you might as well just add that, and then after the consolidation between 2012 and now, I mean, it's not hyperbolic, and I mean that in as far as exaggerating. It wouldn't be a stretch to say that wouldn't be the next leg up. It's certainly, that's how you read that chart. So we're looking at an 8 to 10 time X move up, gets you to close to $16,000 gold. Now, I never like to put a price projection out there, because then this video won't age well, and there's a lot of people that like to smash down the price of gold. But today we can and Jerry had some good thoughts about this too, about how perhaps the West is starting to lose its control on pricing. What's going on outside the United States, where we can no longer manipulate it or contain it? What do you think, Jerry?
I think that's the major thing for precious metals is the pricing. Far too long, New York and London have, and in some ways Switzerland, have had this privilege of giving us the gold and silver prices, where these places, they don't mind it. 60% of the gold and silver production are done in the East, former Soviet Union, China. India has massive amounts of gold imports over the past 2 years, world record imports for India. They have exchanges, and these exchanges have the ability to price. And right now, the premium in China for gold is much higher than the spot price here in Canada. So here in the U.S. and North America. So for sure, this is the he who has the gold makes the rules. You have to have the gold in order to set a price, and to have that privilege. I think that's how you pull the rug right from under the old guard, by taking away the price and giving the opportunity. It's a huge opportunity for arbitrage, where you can buy it low here and you can sell it over here. It's an increase the vacuuming of metals moving out of North America into the East. So it's very exciting. I love the chart because it gives the reasons. U.S. sanctions, the bullying that's being done using the SWIFT system. And just by unsubscribing with gold, this is the way to do it. You don't want to be bullied? Well, I don't have to participate on your old system. I'm moving to something different. So it's a very exciting chart. And 16,000. We were running some numbers earlier, right, Jeremy, with projections in this era of the 70s to 80s. That was the stagflationary period, and this entire week, media was just talking about stagflation. So this is a lot of the topics that we discuss with the clients that come to Guildhall. This is an era that we have to be ready for. That's my thoughts, and your thoughts, John.
I was going to just pick up on a few things you said, especially on the other nations, the World Gold Council releases how much central bank buying of gold there's been by, I mean, Singapore just got released today, Poland, Turkey, you mentioned India, we're talking Libya. You just go on down the list, and these are records that we haven't seen for over 50 years. The amount of gold buying, it's just month over month, they're breaking their own records, and they were just massive year end 2022. So if they're doing it, they know something too, right? I just think it's don't listen to what they say, but follow what they do. So that seems simple enough for me. What about you, Jeremy?
Well, I think this chart is a perfect setup, just a macro view of timing. And I think that it's a good one to just kind of keep image in your mind, because the next ones are really going to tell more of a story. So with that said, I say we move on to the next one that you sent over here, which is a little bit of a longer one. I think this is, again, also just kind of giving us more of a setup, right?
Yeah, this is silver. I mean, everybody talks about gold all the time, and that's more or less what Sergei Glasiev authored, the Gold for Oil, which is the BRICS playbook. But silver and gold should always be talked about together. Yes, silver has all these massive industrial uses, and sometimes people try to use that against silver. It's like, well, why would you? If we're doing a transition to net zero and silver is the best connector of electricity, it helps silver. But silver is also a monetary metal. So we're looking at this 54-year span. There's an old cliche that goes, the wider the base, the higher in space. As in rocketing, like that red arrow showing, closing in on the gold to silver ratio, more on the historical. Right now it's at 78. It's going to move to 40 by the end of 2024. So do the math on $2,000 gold divided by 45, let's say. That puts you at 50, around $50, 45 to 50.
Sorry to interrupt. Another thing you could look at actually is this point right here. That at that point right there, we hit a 35-to-1 ratio of silver to gold. 35-to-1. This was 16-to-1 back here. So this is 35-to-1. So this just shows you we were nowhere near an equal top to what we saw in 1980. You can start to do the numbers yourself on gold versus silver, what it would look like at 16-to-1. I don't put full credit into that particular ratio. I see it as one indicator that it would be great if, hey, the Dow gold ratio collapses, the silver to gold ratio collapses, the gold to debt ratio collapses. We don't need to necessarily see 16-to-1. I know there's contributors out there, analysts like Mike Maloney. He thinks it's going to go the other way. It could go, you could see the pendulum swing past 16-to-1. Look, those to me would be absolutely great. But just to get to new levels, I think even getting back to a 35-to-1, we would be following this arrow much, much higher, just to get back to that 35-to-1 ratio. Actually, I'll do the math on it quickly here.
What are you going to set gold at? What are you at, 2,000 or?
Well, let's say gold today at 1,900, to go back to a 35-to-1 ratio, which is what we saw in 2011, we'd be back up to $54 an ounce.
Okay,
I mean, imagine just the gains there.
Yeah, well, it'd be a 2x. Where else are you going to double your money? Never.
Yeah, right. Yeah.
I just want to stay. I just don't want to lose. That's how low my expectation is. So in silver and gold, you got to remember last year they were flat, which was a very good year. People are whining, and I'm going, why are you whining? If that's, when Tesla was down 70% against gold and silver, it was down there, and all the other big sevens were 30, 40, 50, 60% down against silver. So exactly. You can't whine about those kind of numbers if you're still chopping sideways. We haven't had liftoff yet.
gold was pretty buoyant. It's been almost 2 years of interest rate hikes, the very thing that keeps the cap on metals. Despite that, gold and silver showed buoyancy, showed very resilient, the resilience that it had during the last 2 years versus, the erosion of the stock market. And coming up, September 20th, your Federal Reserve is going to be slated to potentially hike, do another interest rate hike. If they do, if they don't, chances are that could be their last, because the major central banks like China are starting to cut. Helicopter money's floating out. So this will cause the U.S. dollar index, I believe, to spike through and fall through 96, which will only be this is why I love salivating at this chart. This cup and handle, it's 20-year, very trustworthy chart, especially the pattern. Will slice right through 40, 50 for silver. I see silver going into the hundreds. Considering, we were talking about the slew of data earlier today here at the office, the slew of negative data that came out of the States. From, the inflationary data, the PCE data, the inflation data came out much, much higher. All the data is pointing to stagflation. And that was a stagflationary period of 70s to 80, where gold and silver perform. Commodities had a super cycle, going up on average 400% during that decade. So, what did gold and silver do during that stagflationary period? Well, gold went up 8 times. At 1940, where we're at today, that puts gold to what, 16,000 US per ounce. If we go back to a 20-to-1 ratio, silver's at $2,750. So, to say that it could go there, I think we can't negate and be naive that silver can't, when we have cryptocurrencies sitting at 20,000 and 4,000, when these cryptos have one utility. It's just, I can send you some crypto, you send me crypto, and that's it. That's the only utility that these things have, right? Whereas silver, you can't have, you can't have civilization without silver.
Right. You're speaking to what we call, it's intrinsic value, right? Don't get me started on Bitcoin, because let's say we're at war right now. There's 3 aspects of war, usually, or 4. The kinetic war is, the people fighting each other with weapons. There's the information war that we see every day on the media spin. But the biggest aspect of war is knocking someone off a power grid or cyber warfare. So why would you want to have your money stored, in a computer? That's the riskiest thing you could ever do. Because that stuff, and not to mention the fact that all computers have built-in obsolescence. So that storing money on a ledger in the internet is the dumbest thing you can do. So what? A few people made money on these altcoins, but it's just a flawed business model as well. It doesn't perform any of the characteristics of money in terms of being portable, divisible, fungible, and having intrinsic value. It's digits on a screen that the government can seize, just like your Trudeau did during the truckers' strike. I think he seized the Bitcoin, didn't he? I know he did. I know for a fact he did.
Yeah.
Yeah,
Anyway.
I think that my take on it is, why pick a fight with the gold people? Like, why make that your sales presentation? I'm going to pick on gold. It seems silly. It's stay in your lane. Present something on its own accord, what it does for you, why you should hold it, and don't compare it to gold, because I think you just open up a Pandora's box. Gold's on the table of elements. Like, what are you comparing to? And then one's a currency, which is a medium of exchange, and one is money, which is a store of value. They're very different. I think what they have in common, John, I'd like to get your kind of take on that, is I think what they have in common is banksters and government. I think we can both agree that if we could just get the banksters out of government, then we could have some sort of free money. And I think where they come along and they say, well, this money is honest money because they didn't make it. Whereas we come along and say, well, ours is honest money because they didn't make it. So I think there's probably some common ground.
That's right. A good salesman can weave that live. The problem is it's not decentralized. That they first of all they take all of gold's talking points, and then at the last set, it's the opposite of decentralized. It's extremely centralized. You can this quote blockchain ledger is extremely transparent. Gold and silver are very anonymous, and your asset isn't someone else's simultaneous liability. There's no counterparty risk. The definition of counterparty risk would be if the grid goes down, you have no money. If the grid goes down, your silver and gold still shine in the candlelight. So I think they were smart to weave that story that it's like digital gold, but why are you using the word gold? And why are all your logos look like gold too? I just think it's kind of like gold 5.0. Gold doesn't need to be improved upon. Neither does silver.
I don't want to go too far down the road here, but you know what? You make a very interesting point. I think that a crypto person would say to you, well, the lights aren't going to go off or whatever, something like that, right? I don't think it's a matter of gold, that it's that gold shines in the darkness. I think it's that's the acid test, right? That, hey, we want to take this to the very furthest degree, and in the furthest degree of wide-ranging blackouts in India or Mexico, or all of a sudden they're happening here. Why? Because everyone's driving electric cars. Okay. Why? Whatever. The point being is that I think that it's you could definitely say, look, at the far end of the spectrum here, as an acid test, lights go out, yours is useless, gold still works. That's if we want to go down this road. I still think they should just stick in their lane.
Okay, that's fine. We don't need to I'm not. The reason it comes up is because it's a theme that that Jerry picked up on, and I agree that there's sort of this narrative that they shouldn't really compete necessarily.
Yes, I agree.
But I guess it's what you said, stay in your lane. And I will add, though, that we will be seeing in our future a lot of blackouts, not just caused by the power grid being overwhelmed, but there really is going to be a big scramble for energy. And it's also a nice government trick, just like the rollout of some disease protocol or whatever the next excuse is to print a bunch of money.
Yeah.
A good way to lock down the population is just to switch the lights off. I mean, we see it all the time in other nations that want to control the population, but it's sort of part of the fascist playbook. And I don't want to sound too tin hat on this particular podcast. Let's just keep going with the charts that are there. And I apologize for attacking. Here's a good one. It's never gone through a recession. It's never been.
Yeah.
Okay. So let's just end with that.
Yeah.
If you've never been, how many recessions has gold been through and regime change? Come on.
Yeah.
Yeah. Jerry, that's certainly something I've heard you say as well. So let's just review. So we're looking at gold here. Look at what it did through the 70s. That is a cliff face right there. And here we are now today, still making some sort of, we could say, making a power base here. That what does the next run up look like? And I think we've seen that the red line there.
Look at the jump in 2000 though, real quick. That was a killer one too, starting right there.
Yeah.
I mean, that's a big ski. I wouldn't want to ski down that hill. That'd be a double diamond, black diamond.
Yeah. And so here we are, nice valley, back up, looking good, especially just geopolitically, everything that's going on economically.
Right.
And then here we have our cup and handle for silver, which is sort of a smaller version of this area right here, right?
Correct.
Yeah, sorry, I should say a large version of this portion of the chart. So now you brought up this chart. Talk to us about this.
Well, it's just like that first gold chart. It starts with the Nixon shutting the gold convertibility there, and there's that same move up. What 3,770%? Do you see that in yellow?
Yeah.
That's just
Wow.
massive. That's a 37x move.
Yeah, without
30
China or India involved in that.
That's right. And then a 13x move. And then, then Jerry just did the math. So it isn't like smoking hopium to say a 10x move is likely. And sometimes I like to lower the bar, just say, okay, it doubles. You did the math on it going from 25 to 50, being real conservative with like a 40 to 50 to 1 GSR. And by the way, when they mine it in the earth, they mine it with the 9 to 1. For every 9 ounces of silver that are pulled out of the ground, 1 ounce of gold is pulled. So the big mining execs have it down as a 9 to 1 ratio as far as how they're distributing their resources. That, to me, that's sort of a telegraph for what what the potential is. Or they wouldn't be or they'd be allocating more to their gold effort.
Okay, yeah, let's keep going, because I think we're going to bring it all together. So let's talk about this one a little bit.
We'll let Jerry talk about that one because he loves saying, he has the good slang for the froth or slosh or whatever. Go ahead, Jerry.
Yeah, this is all of the equity market here, the global equity, the global, we call financial assets. Look at this, just money sloshing around, and this is, and then just compared to these finite markets, natural resources with intrinsic value. Look at the size difference, and the interesting thing with what appeals to me and why I feel this is a very exciting chart to look at. It's the Exeter's pyramid, because when you look at all of the money that's been sloshing around for, into these derivatives, and you have commodities, all of those financial assets, when they start seeing the metals markets starting to do the X, the 1X, the 2X, the 3X, that's when these markets in Exeter's pyramid up at the higher risks of default decide to jump into the finite gold and silver market. Right. And you just need 1.5% of all of that money sloshing around to run into gold, and less than 1% into silver to eliminate all of the investable silver. And that is what we'll call mania. When you cannot get your hands on it, the unobtainium price of physical precious metals, the numbers that we were just crunching, I think they were pretty conservative, in my opinion, because when you cannot get your hands on the items, when the lockdowns are happening, people were rushing to get toilet paper. You couldn't get it, and you had to just fight for the stuff to get your fix. Imagine what it will be like when institutions cannot get their silver to maintain their industry. I think the gains will be remarkable, but it'll be a very unnerving and testing time to see what civilization will look like. And those are my thoughts.
I think we're going to get to
think?
see it. We're going to get to see it, I think, based on, it's just math and physics and supply and demand. I mean, the Silver Institute and those publications, and they do a great job of painting the exact how much supply is out there. What we're seeing in the new solar technology are the HJT panels. They're an upgrade from the TopCon panels, and
I love those.
They use double the
both sides.
Yeah, both sides, and they use the load of silver is much higher, and the numbers that are coming out of China and India and Europe is even ahead of their milestones for transition to net 2050, net zero. They have them in milestones of 2030, 2040, 2050. They're going full steam ahead. So, and it's not just solar panels, but it's military and shells, missiles, night vision goggles,
technology,
electric cars, batteries. I mean, everything's powered by a battery. This laptop I'm on, thank God, I'm not near a plug right now. My kid, I mean, I am, but they're all used by my kids' devices. Jared, I'm kidding.
Jerry, you see this global equity market as sort of an analogy to the Exter's pyramid, that you could almost put in the slices of the Exter's pyramid in here of bonds and derivatives, etc., all into this, and that you see the natural resources as the inverted peak of that pyramid. And so if we think about that, then you can look at the other charts we were looking at and say, oh, imagine what would happen if just some of this of the money in here built up into here starts to move into this section. You would have those massive gains that we were looking at in here, right? I think that's
100%.
the overall slant of what we're talking about today.
And it's right there in that last chart right there.
Yeah. So talk to us about this one, John.
Well, those swings are very predictable. We're in what's called a commodity bear market. Okay, so that it's right there at the low right. It can't get any worse because of what you just described with the especially, we can just take US as a small market example. I mean, it's a large market, but as a case study. If you have all these zombie corps, like I said, the S&P 500 is held up by 7 companies, comprise about 93% of the S&P 500. So money doesn't just disappear into, as Manarino says, money heaven. It rotates from debt markets to companies that have horrible P&E ratings. Some are zombie corporations. And then they always find their way into the things that we need, the hard assets, your brick, your aluminum, your palladium, not just gold and silver, but all the metals, food, soybeans. Soybean is a really good play right now. Sugar, a good play. Coffee, all of it, but they're not on Exter's pyramid. Because they're not really stores of wealth. Your corn will go bad, right? But it's still a better play than some of these financialized things that are past. Bad assets during the crash of '08 were bundled together and given a new name and passed off to where a bank could count it as somehow like it's an asset, when all they were doing was repackaging bad loans and giving it a new name, and there's your derivative. So that kind of system is what we call a house of cards.
Yeah.
So, and there was a lot in this short show, and I apologize in advance for the crypto detour. I shouldn't have done that, but it does. We're all friends, right? Yeah.
Yeah, I'm good with that. I think that I think that just looking at those charts and realizing where we are, and I just made a quick note while you were talking there about, Gregory Manarino calling it a rotation. And I was thinking about the idea of a great rotation. And, that kind of perhaps is going to be based on the great pivot. I think we were all disappointed by, or maybe we underestimated the pivot. I think, so many podcasts and YouTube interviews and stuff were saying, oh, just wait till early 2023. You're going to see the great pivot where the Fed just takes it all back and reverses course. And then at that point, it's going to be pandemonium. I think it's lasted longer than we thought it would. I don't personally think that it's out of the cards, that it's no longer in the cards, I should say. I think it's still coming. We don't know what it's going to look like now. They've been talking a lot, but I think once that happens, you will go from the great pivot to the great rotation, where people move out of those derivatives and they move out of those equities. And I think, for me personally, I think that if I could give a takeaway for today, it's that you don't want to be part of that rush, because we've seen the market over the years have massive upswings and massive downswings. And when you're in the middle of it, I don't know if you've experienced it, John, but when you're in the middle of it, you feel like a lifeguard in a tsunami. There is only so many people you can help when the market is going absolutely crazy and you're taking 50 calls, 100 calls in an hour, and you can only help so many people. And that goes for the downside as well. But I think when you look at those charts and you can kind of see what's coming, another cliff face that's going to happen in a very rapid way. I think you want to sit back and think about, well, maybe I should do this. Maybe I should be strategic and get in a bit earlier than waiting for that to happen. Last few minutes. Last thoughts on your guys. What you think?
Jerry, go ahead, and then
that's definitely the strategy, is to convert out of financials, convert out of paper-based balloon bubble territory assets, and convert to strategically position to protect your wealth. But why not tactically add more ounces? If you see the charts, if you can take in these charts, these are very strong charts, a very strong case for a 10x potential, 20x play in metals. Why not put a little bit more into precious metals and take advantage before the window's shut? Because when everyone tries to head to the door at the same time, you're not going to get out. That whole ICE 9 event with the stock market. So in my opinion, I think, better to have these basing periods to kind of analyze proper, because when we start hitting that hockey stick, it's going to get slapped up pretty quick. And the markets are it's gonna start running rapidly. Those are my thoughts, John, and yours.
Good thoughts. I was gonna add two. We just talked about sort of the need for people to be positioned before before you're. I guess the best analogy is like running for the fire exits. Hey, Soren, turn that down for a sec. The other thought I had was that the institution, when you looked at that chart that had equities overvalued, okay, it's not just personal investors, but institutions. Let's say it's in, like, for instance, we're in Pittsburgh area, the public employee retirement account for all Pennsylvania teachers, or the largest one is the California public employee retirement accounts. They're called PERAs, PERA. So that's an institution. Then the universities have endowments, but insurance companies have to also, they collect premiums, and then if someone dies, they pay out the benefit. So we're starting to see that these institutional investors have the same data that us middle class people have. They're pretty good at this. So they're going to rush in too. I just want to make sure people understand that. So that there's some competition. And yeah, it does sound, we're not really selling anything as much as sharing knowledge, because you would do the same thing if I know people that are fitness junkies or eat well, and they like to talk a little bit about, some of their secrets for preparing food, or, whatever your passion is. I know people that are into golf and tennis, and if they have a discovery that's saving them agony, or Jerry, you and I were talking off air that you're a coach, you just want to give tips. I mean, it doesn't make us an expert. It's a lot of this is just common sense. So those are my final thoughts.
And John, what are you working on this week? You've got the Pickaxe newsletter, right?
Yeah, I'm working on getting my son to turn down. Soren, you have to turn that down. Okay. We don't even edit that out.
Working on it.
No, don't worry. No, but you do have a news.
What I'm working on this week is, we decided at Wall Street Silver and the Pickaxe and Silver D Gin Club that instead of having 0.5% of the United States or Canada or the world being stackers, that it would make more sense to reach more people. So instead of preaching to the choir, which creates a confirmation bias or an echo chamber, that we're going to be a little different. So each week we are going to bring in a new subculture. They could be bikers, hikers, skiers, golfers, punk rockers, tattoo junkies, video game freaks, geeks. It doesn't matter, because you said it. Actually, you guys taught me this lesson. The first week we sat down, you said that when you first sit down with clients, that you talk about how you've never met one person that doesn't, or that believes in the concept of being a debt slave. So we think that people on both sides of the aisle or if you're a gun nut or you hate guns, both of those diametrically opposed paradigms or mindsets can both embrace the idea of hating debt slavery. So like we had James Mercer, who's a pretty famous musician, on just today. He's in the rock band The Shins, but we're going to have other sub pop label people like Mudhoney and some just people, and then country and westerns people. It's not the whole celebrity thing. We may have a prepper one week, and then we may have a gun enthusiast, and then we may have the opposite person come on and talk about so we're that's our new goal, is to reach different subcultures, just to grow the movement beyond the 0.5 to 1%. We're excited about that. It's an ambitious goal, but if we work together, we can do it.
I love it. I love it. Yeah, everyone should have some goal to protect themselves. And this week, wow, those charts were fantastic. I'm gonna go look at them again. I'm gonna put them into regular rotation. I think they just show that really good things are coming. So I think with that said, we'll sign off for the week, and we'll talk to you next week.
Okay, take care.
Okay, thank you.
too.
Bye.
Thanks, John.